It's time for your Friday coffee with your mortgage man, Eric. Cheers. So today we're going to get into some of the changes that happened in the Arizona real estate purchase contract. And that took place, I think, February 1st, 2017. So we're not quite a year into these changes. And I'm just going to talk about one specific change and how it has affected VA loans, VA financing, and the detriment that it has caused, in my opinion anyhow. And I do quite a bit of VA loans. And tune in all the way through, because the moral of the story is, I think at the end is, man, not every VA lender is on the same page, man. They do not create them equally. And even if you're not a vet yourself, one, if you're a realtor and you ever do write a VA contract, you want to tune in. And two, if you're a consumer, and you're not a vet, that's okay. You probably know somebody that is a parent, a sibling, a friend, a neighbor, right? A coworker that at some point may be getting a VA loan. So tune in. We're going to kind of get deep into the weeds of some stuff here. So you might have to follow closely. Here we go. So on the old real estate purchase contract, it was lines 71 and 72. And they actually had its own paragraph, its own section of the real estate purchase contract that was deviated to VA financing, all by itself. That was what it was there for. And this is where you would put in there. First off, look, there was a hard embedded code in there for the escrow fee, because the veteran can't pay for the escrow fee. That is a VA non-allowable fee, and we've heard those fees. That terminology for years and years. What's the FHA non-allowables, which went away in 2006, by the way, but I still get that question every now and again. Anyhow, moving on. VA non-allowable fees. What are your VA non-allowable fees? We need to get them in the contract, right? So, because we know the veteran can't pay for them. Wow. Have things really changed in the last few years? Here's how. The old Arizona real estate purchase contract 71 and 72 allowed for the real estate agent to put in a line on how much the lender's VA non-allowable fees were. And like I said, there was a hard bedded in code. It was the escrow fee and a blank line, right? And in that blank line, you would see generally anywhere from $1,000 to $1,500. 1,000 on the low end, 1,500 on the high end. So include the escrow fee, you'd come in somewhere between 1,800 to 2,200, right? Somewhere in there was the general ballpark, general vicinity of what the VA non-allowable fees were. So in essence, right, what we were doing, the sellers knew this, the listing agents knew this. Hey, there's going to be some fees if we get a VA buyer. There's going to be some fees that you, the sellers, got to pick up. It's just what it is. God bless our veterans, right? Look, they've served for our country, and they didn't do it for very much money, and they living with post-traumatic stress disorder and being displaced from their families, right? They deserve certain benefits, but we've stripped them of some of these benefits in the Arizona real estate market. Here's how. The new contract that was put out by AAR, Arizona Association of Realtors, in February 2017, stripped the whole section, lines 71 and 72 from the purchase contract, and have a tiny little, some verbiage at the end of a sentence in line 102, I believe it is, of the new real estate purchase contract. What a shame. Doesn't even mention the escrow fee, hard-coded, embedded at all. And it's lumped in with seller concessions paragraph. Just, look, man, this is a detriment. I am not sure why AAR did it or who in AAR is responsible for it, but in my opinion, I'm speculating here, they didn't take into consideration some mortgage experts that write, VA deals. They didn't talk to the lending side of things. They didn't talk to realtors who do a plethora of VA loan or VA purchases. on the buying side. That's just my speculation, because if they did, they would have never got rid of that. Because now, our veterans are assumed to pay those fees. Now, here's some misunderstandings that I hear sometimes from the listing side. Yeah, but Eric, those fees aren't non-allowable anymore. Yes and no. Okay, first thing, the termite fee in Arizona, that is now an allowable fee. Yes. So the $69 termite fee, blah, 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 big deal on that, right? We're not talking about that for the most part. Since the regulatory environment has just pounced the mortgage industry, one of the things that we've seen in the last couple of years is the lenders have done away with what we call the underwriting fee, the doc prep fee, and the administration fee, which were your lender's fees in the VA loans. They are the fees that are non-allowable, set forth by the VA. So what has happened is that the lending community, by regulation, had started to morph into a different fee. Okay, we're going to get rid of those fees, and we're now just going to call it an origination fee. Or they even went worse, and they just put it into the interest rate, right? I mean, you guys know there is no such thing as a no-cost loan. Oh, the lender has no fees. Really? You guys know better. There is no such thing. There are fees with everything in life. It's just that they may take that fee and put it into something else, like your interest rate. And that's what happened with some of the bigger institutions, is that, we don't have any fees on our VA loans. Okay, yeah, but you got 0.25% higher, right? I mean, that's how it works. There is no such thing as no fees, so they're going to embed it somewhere else. So now we have the veteran paying a higher interest rate on their mortgage for the next 15 or 30 years, normally 30 years, right? And what does that calculate out to? Thousands and thousands and thousands and thousands of extra dollars in interest that the veteran's going to have to pay. So look, I think those lenders that put it into the interest rate, you did a huge detriment to the vets. Huge detriment. The other way of charging the origination fee, now that fee is not a non-allowable fee. So now we have the situation where we've just got to ask the seller for regular concessions. And it's unfortunate, because what happened with the regulation came to the lenders and said, hey, you can't differentiate between borrowers. You have to charge the same way for every single VA loan. You can't say, hey, we got concessions on this one, so we're going to list the fees, give the veteran a lower rate because we got concessions, right? And then the next loan, we didn't get concessions, so now we're just going to, not charge anything and give the higher rate. You as a lender cannot do that. That is against regulation. Regulation says this is your VA template. You have to charge every VA borrower that comes into your institution the same way, same fees, same line item. Well, look, that's where regulation is out of control, doesn't have any common sense, and it has come with unintended consequences, and in this case, it is to the veteran. So the thing that we've got to understand with this, right, is that not every VA lender is created equal. So now what has to happen? You need a lender, a loan officer. It's going to be able to communicate with your buyer's agent that says, hey, they're probably still expecting the terminology, the verbiage on the other end of, so, I understand we got to pay for some non-allowable. So they're kind of anticipating that they're going to have to cover some fees. And that's where we've got to come together, and you've got to find a lender that still has fees associated up front so you can get a better interest rate, for Pete's sake, right? We've got to be able to do that. Now, This is where, like I said, it correlates, it segues into some of your lenders you could be picking out there. And I'm telling you, the place that you want to stay away from as a vet is USAA. And here's why. Is that when you call USAA as a vet and you're getting a pre-approval, you talk to a customer service rep. You're not talking to a licensed mortgage loan professional. You're not even talking to an unlicensed mortgage loan professional. You are talking to a customer service rep. At first, knows very little, reading computer script. Now, you will be given to a mortgage loan officer who's not licensed, but at least the designation, they're a mortgage loan officer, once you are in contract at USAA. And I'll give you a great example why that is important on having a professional, right, that knows the guidelines, that knows the ins and outs of VA financing. Perfect example. 2 months ago, just because a veteran is using a VA home loan does not mean that they don't have any money to put down. Misnomer. Boing! I tend to see plenty of those that do have, especially later on in their 40s and 50s. They have some money. They could go conventional, but they want to use their eligibility. Put 5-10% down. They don't have to have any mortgage insurance. Bingo. Plus, they get a lower rate. VA rates are better than conventional rates. Boom. Okay. So now on the VA loan, you know there's a funding fee unless you are funding fee exempt because you are disabled. You have to be service-related disabled by 10% to have your funding fee exempt. Your funding fee is like your upfront mortgage insurance premium. First-time user is 2.15, and your subsequent user is 3.3. So let's say you're a subsequent user. In this example, 2 months ago, they were going to get hit for a 3.3% upfront mortgage insurance premium funding fee, terminology set forth by the VA. But they, 700 plus FICO scores, money in the bank, and I said, hey, what if you put 5% down? Think about that? Well, why would I do that? Because here's why. You put 5% down, I'm going to take your funding fee from 3.3% to 1.5. Really? And it saved them thousands and thousands of dollars on their upfront mortgage insurance premium / funding fee just by putting 5% down, right? And it gave them a little bit of better rate, and obviously their payment was lower because of a lower loan amount. Nobody ever discussed that with them. And they were already over at USAA and had a pre-qualification, candy caned. I don't know how well of a pre-qual you get from a customer service rep, right? Plus, they never were talked to or communicated to about that option. So the veteran loved the fact that I spent time with him, gave him that additional option, and of course we closed successfully. And they actually put 10% down and brought the funding fee down all the way to 1.25. They didn't have to, but that was their choice. So where I'm getting with is not all VA lenders are created equal. Not all VA loan officers are created equal. Be very careful on who you choose. Don't get bought by the big commercials. Listen to your realtors. They usually know their local direct mortgage lenders. And even within this pocket, this community, this local industry of lenders and mortgage loan originators, there's even a smaller fraction of those who do VA loans and who do them well. Look, it just is what it is. I manage a branch of loan officers, and when they bring a VA loan in, I've got to manage them closely, and I've got to walk them through it, hold their hand, and that's not abnormal. So just be careful. I wish we could go back to the way things were with the old contract because it was better for the veteran. So knowing how to navigate around the new contract, the Arizona Real Estate Purchase Contract line, now 102 it is, and we've got to bring that to the seller's attention. With that said,